Welcome, everybody. Hope you guys can hear me. This is Nate Hare, the Executive Director at Directed IRA. We're got a very, very special workshop with a good friend of mine, Ron LeGrand, the godfather of real estate. I've known Ron for about a decade now. I've learned a lot from Ron. Thousands of other investors have learned a lot from Ron. So you guys have a real special treat that he's taken a little bit of time out of his busy schedule to join us on the Directed IRA workshop. And we're just going to really just jump into it. I want Ron to kind of just talk about the ways that he's buying real estate, that he's bought real estate, where he's found success. I'm sure you guys are going to pull some nuggets out of this. And if you don't retain everything on this workshop of what we're talking about, don't worry. There are so many resources that not only Directed IRA has, but that Ron has, where you can learn more about how to buy real estate with different techniques, how to buy real estate on terms, how to do all the creative things that he's been doing for decades and teaching investors all over the country. So drop this screen, Tristan, and let's just bring Ron up. Ron, are you with me?
I am. I'm here.
How are you doing, sir?
Outstanding. You see the weather here. I don't know how you could get it better.
Well, it's pretty nice here, but I agree with you. Florida is nice. Just to give people some perspective, I just spoke at Ron's mastermind. What a beautiful venue you guys had out at St. Augustine.
Yeah, it was.
Yeah, great. We had a great time out there, and I've been going out and speaking at Ron's events for a decade. You know, if you don't know who Ron is, let me just give you some background. And I'll have Ron explain a little bit about himself too. He's written several books. He's owned several companies. He's bought and sold thousands of real estate properties of his own. He hosts live events. He hosts masterminds, podcasts. In a lot of regards, I would say you've been ahead of the curve in how you distribute information and education. You've got a database of about 500,000 people that receive your content. Where did this all start? Where did Ron LeGrand go from real estate investor to real estate coach, mentor, and doing the things that you still do today? What keeps you going?
Well, I started in 1982. So I'm in my 41st year, the way I calculate it. So I was in about 5 years before I started teaching it. And that was because everybody was asking me the same questions. So you see, I was buying houses, started in my local RIA group. And finally, I decided, well, I'm going to have a seminar and teach all this stuff in one place that I know. And I did. And the first one was free, had a whole room full of people. You know, I couldn't believe they wanted to come hear me talk. But they convinced me that they did. So the next seminar, I actually charged for it. And it was a much smaller room, Nate. And that, frankly, that's how I started teaching. And that was in 1987. And I've been teaching it ever since and practicing it to this very day. And we've got an awful lot of folks out there that are doing very well because I decided to start teaching it and continue. We do more than teach. We support them as they go. And, you know, we don't love them and leave them in the morning. We have mentoring services to make sure they walk them hand by hand through the deals. So we got, you know, as evidence in that master's, the master's means that they're at our top level. And where you were at is the annual retreat. And we have some really cool people in that. Some of them making some really serious money.
You did. And the thing that I found with your students is they're serious. They're not tire kickers. They're people that are putting your strategies and your education into play. And it's a lot different than a lot of people who are providing, I would say, education and mentoring that are selling them something. You're not really selling anything other than providing them, you know, what the tools that you use in your tool belt that have made you successful in real estate.
Well, we sell training, but frankly, that's worthless without the implementation part. So we also help them implement so they don't waste the money on the training.
Right. So for over 40 years, you've been buying and selling houses, and you always say without any use of your own money or credit, everything from wholesaling, rehabbing, but your favorite way to buy real estate is on terms. Yep. Explain to the audience how that works and why you find that's a better way to buy and sell real estate.
Well, first of all, I started wholesaling houses and then started rehabbing them using private lenders' money. And then it was years later till I started gravitating into the terms business. I think I fell into it by accident. But when I'm selling a house on terms, that means I'm lease optioning to the tenant buyer and giving them a chance to go get qualified for a loan, because I'm working with people who can't qualify for a loan right now. So I put them into a house of their own. They pay rent, fix whatever's broke, and then they go apply for a loan. And because of that, when I put them in the house, I haven't really sold the house, but now I get all the benefits of not selling the house, in addition to a great big old check up front called a non-refundable deposit that they have to give me to option my house. And it's not measured in hundreds, it's measured in thousands, because they literally have the ability to buy the house, but they got to go get a loan. If they don't go get that loan, then they forfeit that deposit. And we get anywhere from 5% to 10% of the sales price as a non-refundable option deposit. Plus we get more rent than we would from a straight tenant. And we put all the repairs onto the tenant buyer after the first 30 days. So we get appreciation, which was huge the last couple of years. We get depreciation, which is also huge. People tend to forget that, but I hate paying the IRS. So the less of that I got to do, the better. And it's free, it just comes with a house. They get debt pay down. That's huge as well. People don't think about that until they're about 10 years into the deal and look at their debt and say, holy crap, that's all I owe on that house. They also, many of these people will forfeit their deposit because they simply don't go buy and they decide they want to move. I never moved anybody because they didn't buy. I just move them when they don't want to pay rent, which is really rare. When I got thousands of dollars of their money that they can't get back if they don't buy or if they leave. So I don't have to worry about tenant turnover. You know, when I'm forfeiting $20,000, if I go to someplace else, I'm going to think about it twice, and I'm not going to move. So my tenants are very stable, very long tenants. I get all the benefits of owning real estate without all the grief. Now, it only took me about 20 years to figure that out. You know, I'm a slow learner, but today I will never put a tenant in a house again. I'll put a tenant buyer in the house and get all those benefits, whether the property's inside or outside my IRA.
So really what and this is what you've talked about a lot in your classes is lease options, tenant buyers. I think for most people, when they hear this, they think, well, what's the difference between, say, lease option and owner financing from I guess the buyer side? Can you explain to the audience the difference between owner financing and lease option?
If I sell a house with owner financing, that means I'm financing the house for the buyer. They're going to make me a monthly payment until sometime in the future when it's paid off. If I put a tenant buyer in a house, I still own the house. Therefore, I get the depreciation and all those goodies. And they got to go get a loan and cash me out in order to actually buy the house. I'm telling you, most of them just don't. They live in it until they get tired of it, or they decide they can't afford it anymore, or they get sick, or they have to move out of town, or they change jobs, whatever. I don't know. I don't even ask why they're moving anymore, but they know when they're moving, they're going to forfeit that big deposit. So I got iron handcuffs around them. They don't act up. I don't have any problem with tenant buyers because they know that that deposit is at risk if they don't pay the rent. Even COVID, I never had one tenant ask me if they could skip a month. Because I would have told them, you know, if you comply with the COVID rules, I can't stop you from skipping a month, but don't forget you still owe that money, and I will collect it sometime when this is over. And I never even had a request for that because they knew that deposit is a risk.
So you also talk about, and this is a little bit different than most, I would say, real estate coaches or mentors out there who are talking about buying ugly houses. This strategy isn't really used for ugly houses, is it? I think that you buy a lot of pretty houses with these strategies.
I can wholesale a house, which we do. I can rehab it and retail it, which we do. But once I get the check, I'm done. There's no more residual income that I get out of these pretty houses that spread every single month. And on top of that, I got to pay maximum taxes on it because it's short-term capital gain, or lease options, long-term capital gain, half the taxes when it does sell. And of course, combining these things with debt, IRS, no taxes entities, one can grow very wealthy very fast.
Yeah, and I think you're referring to IRAs there, is because here's one of the things I love about you too, is that you've always, from the day that I've known you, you've always pushed on your students that they need to start investing through tax exempt entities like a Roth IRA or an ESA or a solo 401k. Can you kind of explain, I mean, tell the audience how you feel about self-directed accounts and how you use them?
Well, first of all, if I don't have money to pay my bills next week, we probably need to fix that first. And then when we got our cash flow needs taken care of, which won't take long, then we need to probably work as much as we can inside of the Roth IRA and or the solo 401k, and even in an ESA, as you teach us on the road. And I've been doing that for a long time, and I got a lot of students that actually got it and have been building their IRA for a lot of years now. And make sure we talk about the dark side of the Roth here, because there are rules on any of those. There are rules.
Yeah, you have to understand the rules. And I would say you have to understand the strategies, because, one thing that we focused on when I was out there speaking is talking about, matching the strategy to the tax-free account that you're using. For instance, you mentioned wholesaling and investments like that, where you might make a quick turnaround, a quick profit in, say, 6 to 8 weeks. Right. There's accounts, self-directed accounts that you can use the money in 6 to 8 weeks, like a health savings account or an education savings account that allow you to take out the distributions of the profit to pay for current expenses. So maybe those are better strategies in those types of accounts. But when you're thinking long-term, like in your Roth IRA or your Roth 401k, maybe buying on terms or buying a property with seller financing or buying property subject to, those seem, in my mind, great strategies to put in an account that I put on the shelf that grow long-term in a Roth IRA.
Yeah, but while you're on it, I tell people don't buy houses on terms in your Roth IRA, because they're going to be subject to UBIT, unrelated business income tax, needlessly. In fact, I tell them, if you want to put one of these term deals in your IRA, then just lease option it.
Yes.
Because now that's not debt.
Correct.
On the other hand, now we got the solo 401k. We can buy a term deal in it, and UBIT doesn't apply. So you're correct. Which entity is best for the type of property that I'm buying?
Yes. And a lot of your students are self-employed. And that was the one thing we focused on is if you have a solo 401k, one of the benefits to a solo 401k that you don't get an IRA is you don't pay tax on debt. So I would say do all your debt leverage strategies, seller financing subject to, in a solo 401k. But the biggest difference between, go ahead.
Okay. So wholesaling and rehabbing are great for your Roth.
Yep.
Assuming the money is in your Roth to do the rehab and the purchase. Because if it isn't, you can go borrow it from a private lender as long as it's non-recourse, but now you just triggered UBIT if you do. So you don't want to do rehabs in your IRA unless you got the money in there to buy it and rehab it. And then, of course, here comes that $50,000 profit right back into your IRA. And you know what? I find, Nate, that people have to hear more than once how magical this is. They just... If I put up $100 deposit to bind a contract on a junker house, and I get $30,000 by flipping that junker house, $30,000's got to go in my IRA, for crying out loud. So it ain't about contributions; it's about using your IRA to buy and control real estate and leverage your brain and not your wallet. Yeah. So you tell me, how much faster do you think money grows tax-free rather than taxed?
Oh, it's considerable difference. And I know which one the IRS would rather us do.
Oh, okay.
Yeah, well, they would rather us do the one where they get a little piece of the profit.
Yeah. Well, so the IRS, let's assume that I am investing $100,000 outside the IRA into a house, and I buy that house. I don't know, let's say I buy $1 million property and I put $100,000 down to buy it. Well, that $100,000 is going to stay in that property until it is sold or refinanced. So that property's got that money tied up. I can't use it. Let's say I learn how to buy houses without money, same $1 million worth of property. And now I can take that $100,000 and I can invest it in something outside of real estate or even in real estate to get the humongous rate of returns. But if I just invest that at 15% interest for 10 years, that money in my real estate is going to be worth 10 times that same money outside my real estate. Property is going to grow in value with or without my $100,000 in it. So learning how to buy property correctly compounds the use of the IRA many, many, many times. And you try to get people to understand that first shot. I mean, you're talking to a post and they have to hear it about 3 or 4 times. Then they have to see examples of it. I mean, who would believe I could put up 100 grand and get 30 grand back?
I didn't believe it until I started learning this, going to events like yours and learning it firsthand from people that were buying.
Sounds illegal to me, don't it to you?
Yeah. Well, even a self-directed Roth IRA sounded illegal to me the first 2 weeks that I learned about it. I thought, how come I didn't learn about this in school? Why has it been 12 years I've been in the mortgage business and buying and selling real estate that I'm just learning about self-directed IRAs? Yeah. So that's why I've been passionate in the business doing this for 11 years, because I feel like every single person that I talk to about self-directed IRAs and creative real estate strategies goes, God, I wish I knew about this 20 years ago, or I wish I knew about this 10 years ago.
Yeah.
So I want to take some questions here, but I want to make a point real quick, because you kind of mentioned this, and this is really important for people to know when you're talking about buying property with seller financing in an IRA or buying property with a lease option. Buying property with seller financing, you're going to have debt, right? The seller's going to give you back a note to your IRA. Yep. That's a strategy that might be better suited for a Roth 401k, for example. There's still ways to mitigate the capital gains tax, even if you do it in IRA. I teach that in my other course, but the difference with a lease option is that it's an option. It gives you first right to buy the property, but not an obligation to buy the property. So having a right like that doesn't trigger UBIT, because technically you don't own the property yet, correct?
Which is why you can do lease options in your Roth IRA.
Correct.
And UBIT.
And it doesn't trigger UBIT. So creative strategy to get around UBIT is to structure the deal in a different way. Well, okay, so we're gonna go on to the next one. Ron, let's talk about wraparound mortgages and how those play in this equation. Talk about what a wraparound mortgage is and how that plays into these strategies.
I've been using them for 40 years. So it's simple, but so let me see if I can simplify it. Let's say the house from a seller with owner financing, which could either be take over their debt or a wraparound mortgage, or even a first mortgage if they own it free and clear. Okay, now I'm selling that same house for $300,000. Okay, and I get $50,000 down, and my buyer, I will then have an attorney create a wraparound mortgage for the $250,000, which the buyer owes me, which wraps around the $200,000 that I owe the seller. The $200,000 is part of the $250,000. So a payment comes in, it pays on the $250,000, but out of that comes the payment on the underlying $200,000. So that's what it means. A wraparound mortgage is simply one mortgage wraps around the other. Total debt on that house would be $300,000, not $300,000 plus $200,000, because the $200,000 is part of the $300,000. Any attorney can create a wraparound mortgage or deed of trust or land contract. There might all be wraparounds, just different documents in different states.
Right. So if you're in a deed of trust state, it's a wraparound deed of trust. If you're in a mortgage state, it's a wraparound mortgage. What banks are going to allow you to wrap mortgages? Kind of explain that. I know traditional banks won't let you wrap mortgages, but what mortgages are you typically wrapping?
Well, the bank can't stop me from wrapping the mortgage. The bank can't stop me from doing anything that I want to do, as long as I'm making the payment or as long as they're receiving the payment. So all mortgages that I buy on wraps have the due on sale clause in them.
Right.
They all do. You can't get anything without due on sale clause anymore. That means the lender could call it due if they wanted to. However, they don't want to. Okay. They want the payment. The last thing in the world a lender wants right now is a defaulted house. Many of them are going out of business because of that, are having to get sold because of the rates of defaults are going up rapidly here after they got the moratorium for COVID. So the bank can call it due. When I buy it from the seller, I get a disclosure signed that they could, and don't make me responsible if they do. If they just don't, I've been doing this for a long time, and I never had a bank call a loan due, not once, as long as they keep the payment. but it has to be disclosed that they could. So
Right.
that disclosure is on both sides, buying and selling, but it's not anything to worry about. And frankly, I don't want to do it on this call here, but if they call the bank due, I know how to stop them anyway.
Right. And I've probably seen several hundred, properties bought subject to, properties bought where, the due on sale clause couldn't get called. But as soon as the bank gets their money, the past due mortgage payments, and they see the payments coming in, I've only seen the due on sale clause exercised once, in my opinion. I know there's a lot of people out there that say they've done thousands and they've only seen it maybe a handful of times. So,
well, frankly, I would bet you if you track down that one they want to call due, that's because the seller pissed them off so bad they don't want anything to do with it anymore.
Could be. Yeah. And usually it's not the big banks that are called. It's usually the small community banks that have nothing better to do, where the property might have equity, where most times the banks, there's no reason for the banks to call the loan due, because they wind up with a house that they have to figure out how to sell, and that loses more money than had they just kept the payment.
Absolutely. Yep. And again, I tell you, they'd rather have COVID than have to take back a house.
So let's talk about a little bit about the types of buyers and sellers that you're looking for in these situations. When you talk about this, and you're the master at this, when you talk about this, I kind of hear in the back of my head, I don't know, tired landlords. Maybe it's tired landlords that are willing to sell on terms. Can you kind of give the seller profile on how you're negotiating these terms and where you're finding these deals?
Well, first, I'll tell you that I have something off the internet here recently that 34% of the people that apply for a loan get turned down. And if that's true, I'll tell you that 70% of the people that would want to buy a house and can't qualify at the bank, because there are way more people that don't even apply because they know they're going to get turned down. About 70% of the market can't go to the bank and qualify for a loan. Okay. They're all ours because I don't need them to qualify. Only thing I need from them, enough money down and can afford the monthly payment. And frankly, I don't care how long they stay in the house, because the longer the better, because I call these houses golden geese. And last thing I want to do is cash out of them, because I lose all them goodies. And don't forget the front end deposit. Let's say I'm putting somebody in a $300,000 house. They're not getting the keys to that house without at least $25,000 non-refundable deposit going in. So I have to go through some to get to those that have the money. But I frankly don't care about their credit.
Right.
As long as I think they can make the payment, because that's a lot of houses. We're the gatekeeper.
Right. Can you talk a little bit about, let's talk logistics. What are the types of documents that you're using to buy on terms, lease option? I know you like to use land contracts. Can you explain to me the different types of documents that you're going to see in those types of transactions?
If I'm buying, there's only one of three ways I can buy. I'm either in a mortgage state and I'm going to buy it on a mortgage, first mortgage or wraparound mortgage, or I'm in a deed of trust state, same thing, or the seller wants me to buy it on a land contract. All right, no matter how I'm buying it, it ain't my problem anyway. It's the attorney's problem to create the document. I don't create those documents, but I do create the terms that go in the document with the seller while we're putting it under contract. So all I got to do is I got a one-page contract, one page front and back. And when I walk out of that house with that signed, we have negotiated on those terms, and then I forward them to the lender to get it closed. To the attorney, sorry. So I don't do any paperwork except the contract. And that's so simple, you wouldn't believe it. And I've been using it for almost from the very beginning. And you can use it in any state. Worst case, the attorney wants to add a little something here and there. So the documents aren't an issue for anybody. A lot of people are afraid of them, but there's nothing to be afraid of. Just read it a couple of times and see what it says. Then all you got to do is go fill in the blanks, go right down to the thing. I can fill out a contract on any kind of a house in 90 seconds.
So take us through now. Where are you seeing real estate today? We're kind of in an interesting market, high interest rates, yada, yada, yada. You hear all these, doomsday scenarios. Are there certain strategies that play better today, or this is the same strategies that you use? And let's talk a little bit about state specific rules, because some of these things work better in certain states versus other states. Can you kind of expand a little bit on that?
All right. Well, first of all, when I started, the prime rate was 16.8%. Please don't whine about the interest rate. You're lucky. It's not about the rate. It's about the availability of the money. And obviously there's going to be money made from that, or you wouldn't do the deal. And if you hang around me, I'm not going to let you go personally guarantee a loan anyway. Because I mean, I'll send a mean guy with a board after you if I catch you guaranteeing debt. That's the biggest mistake you can make. So I've been through about 6 cycles, high rates, I don't know, all over the years. And every single year I was buying and selling houses for some reason. And in time I learned there will never not be a market for houses. There people always want to sell and other people will always want to buy. So I don't spend any time worrying about things I can't control, like the economy, the president, interest rates. I'm going to adapt to the market as I've been doing all my life and go with what is working now. But the techniques have not changed. The environment has changed. Some laws change, but the techniques I learned back in the early 80s, for crying out loud. So I tell people, take care of your cash flow at your house, and you won't need to worry about what goes on at the White House. Nothing we can do about it but vote.
So, and how are you identifying sellers? Where are you finding your potential sellers?
Methods of marketing to do that with, online and offline. And a lot of it today is free because it's done on social media places like Facebook Marketplace, for example. You just let people know what you do. And when they find out what you do, they will come. So I teach that in the first day of my live event, the whole afternoon is on how you find these deals. Because the truth is, if you don't find the deals, everything else you learn is worthless, isn't it?
Yeah. And I will say, if anybody out there is interested in learning more, where should they go? RonLeGrand.com. Is that the best place to go? Because I will say this.
Go to learn what the terms business is all about is RonLeGrand.com/terms. And that's a really good webinar. And then you'll learn what, you get your questions answered on that thing as well, because I'm sure you have plenty. But then RonLeGrand.com is a big website, got all kind of free stuff on it. But the best place to do is go watch that webinar, and then you can decide where you want to go from there.
Yeah. And I'll say this, one of the best resources out there that I think Ron puts out there is your mentor podcast. You've been doing that for how long now?
I don't know, several years.
Yeah. I mean, almost everybody's on there. I see Pace Morby on there. I see a lot of the people that people lean on today have already been on your podcast. I mean, I've been on your podcast years ago, and you've been doing this for a long period of time. If you guys listen to podcasts or you're looking to absorb more education, you have to add Ron LeGrand's The Mentor Podcast on your playlist. That's
thementorpodcast.com. Make sure you sign up for it, because now you can go to the archives, and you'll never hear, never want to watch all of them. They're in the archives. There's hundreds of them.
Yeah. And one that I just watched the other day, that if you guys want to get a little bit more expanded information on this, I want to say it was episode 101, the difference between owner financing and lease options. That was a great one that I just watched just the other day. So go there. You guys will see. I mean, there's so many different topics that Ron talks about and touches on. It's just phenomenal. So we appreciate you for that, Ron. What do you have coming up as far as live events? What can people look for if they want to participate?
My main event is my 4-day quick start school, which I still teach. And then I have another event on business management coming up, which is the art of running this business and others. And then I have one called, let me see. Oh, I just did it yesterday. Commercial boot camp, all right, where we go into the world of commercial. And then, got all kinds of training materials that they can download and so forth. But I still like doing live events. But, we do virtual and we do live, but nothing replaces the live. People in the room, we can actually talk to each other. And then I know I got their attention as well, which is never going to happen with you sitting behind a computer. Because I've learned that I don't care how many people it looks like there are on that computer watching me. There are a bunch of them or not. They're out getting a sandwich or feeding a dog or whatever. I know, because we turned the thing off, and it's 30 minutes before they even come back on and find out we're not there anymore. So, we can see that they're still on the website. Nothing like live. Trust me, live's 10 times better than on.
It is. That's why I
Pops.
like going out to your events, because having the opportunity to talk live, answer questions live, get people while they're engaged. And honestly, I have so many good conversations outside of the room. I mean, we got pummeled at your event. So many people were coming out there and talking to us. And these were your mastermind groups. It seems like they're always taking a little bit more away at each event. And these are people that have been attending your events for decades.
Taking away a lot more.
Yeah.
Than not watching the screen. I don't know how any human being can sit in front of that screen for 4 days straight. I swear I know. I mean, right. I couldn't.
I agree. Tristan, we have any questions? Any other questions we want to take? So let's pull up my slides. I got some slides, Ron. I just want to go over a couple just quick case studies real quick, give you a little break, and then actually show some people how some of these strategies really play out in a self-directed IRA. So Tristan will pull up my slides here. And I just want to make this, because I'm real visual, and I know a lot of the people that tune in, they're used to seeing a kind of a PowerPoint presentation. So, and for anybody new, let's just back up just a little bit, right? I know we just kind of jumped into some advanced topics, but let's talk about the basics. When you're talking about your retirement account, which is what we do here at Directed IRA, we allow people to use retirement accounts to buy real estate. That you can buy anything in an IRA or a 401k or an HSA. The only things you can't buy in those accounts is life insurance contracts and collectibles. So if you're here to learn how to buy rentals, fix and flips, commercial property, apartments, investments into private equity, private stock, options, which can include lease options, real estate options, notes, and more, you just have to work with a company like Directed IRA that'll allow you to buy those types of investments and administrate those types of investments so you still get your tax benefits. You're not isolated to just investing in stocks, bonds, mutual funds, and ETFs and REITs. I would say that's probably a way that you could just not get to retirement faster, but investing in things with very small return, but investing in real estate and the things that Ron and his students invest in give you the opportunity to invest in tangible assets with multiple income streams that you can negotiate your own terms. That's powerful stuff if you can understand how to do it in a tax-deferred or a tax-free type of account. These are the tax-free accounts that you can use at Directed IRA to buy real estate, whether you're buying it cash, whether you're buying it on terms, whether you're buying it with other sorts of leverage. There's 7 types of accounts that you can use to put these strategies in play. Most people only talk about the traditional and the Roth IRA. That's because more people have those types of plans because it's personal plans. Anybody with earned income can have a traditional or a Roth IRA, including minors. A lot of Ron students are self-employed, and I know a lot of Ron students put their kids on payroll. Why do they put their kids on payroll? Because they give them earned income so that their kids can have Roth IRAs at a very early age. I know a Ron LeGrand student has a 4-year-old with a Roth IRA because why? Found a way to get the 4-year-old earned income, and that 4-year-old's got a Roth IRA. If you're self-employed, you can self-direct your own SEP IRA or the mighty powerful solo 401k, which I'll talk here in a little bit because I have a case study about solo 401ks, and me and Ron kind of touched on it about the types of investments that fit great in a solo 401k. But you can also self-direct health savings plans and educational savings plans as well. And those are plans that you can self-direct and use the profit right away to pay for health expenses and education expenses. So let's skip through this because we already talked a little bit about this. But I want to talk about putting the right type of deal in the right type of plan. And this is one that we kind of touched on this, and Ron mentioned this, that 401ks pay no taxes on debt. Remember that 401ks pay no taxes on debt. Your IRA can assume or not assume debt, but your IRA can buy property on terms. Your IRA can borrow money, but the difference is an IRA pays taxes on the debt where a 401k doesn't. So if you're going to buy property with debt, buy it with a 401k if you're self-employed. So this is a client of mine named Randy. Okay, Randy's self-employed. Randy made a whopping $5,000 contribution to his Roth solo 401k. Now, contributions are limited, but profit is unlimited. So just keep that in mind when we think about this case study here. Okay. So He was a real estate professional. Okay. Real estate professional, real estate agent. He was out there looking for properties, and he's got his solo 401k with $5,000 in it. He found a tired landlord. This landlord was a woman who was just recently widowed, and she had 3 warehouse units that her husband formerly was managing for her. When he died, that problem became her problem. Motivated seller? I would say yes, motivated seller. So this property consisted of 3 warehouses, 3 tenants. One was a good tenant, paid pretty consistently every single month. The second tenant started paying infrequently once the husband died. And the third tenant basically became non-existent when it came to rent. So the widow was having a hard time just basically trying to collect the income, and she didn't have a property manager in place because her husband was the property manager. So my client, Randy, met her and decided he would negotiate some terms with her because he really just wanted to find out what the seller wanted from this property. She didn't need cash. She didn't need to sell the property, but she did like the monthly income that the property generated. She just didn't like to deal with the tenants. So Randy offered to buy the property in the name of his Roth 401k on terms. He offered the widow that his Roth 401k would be the buyer. The Roth 401k would give $5,000, the $5,000 contribution as a deposit, and he would carry back a note for $95,000, the borrower being the Roth 401k. Now, does the borrower pay tax on the debt? No, because this is in a 401k. You could do this in an IRA, but an IRA would have to pay taxes on the debt piece of this. So here's basically what he did. Once he took title to the property, buying it on terms with a $5,000 down payment, he rehabilitated the tenants, kicked the one tenant out that wasn't paying, put a new tenant in there, rehabilitated the second tenant who was paying infrequently, make him pay frequently, and the other tenant was fine. But now that the Roth 401k owns the property, where do all those rents go? The rents go to the Roth 401k because the Roth 401k is the owner. He takes that money, and whatever he owes the lady on the note, that's a note payment every single month. And he just keeps this process going. Renters pay the 401k, 401k pays the widow, and he keeps this process going for about 16 months. Okay. 16 months later, the good tenant wants to buy his warehouse for $100,000. So they draw up a sales agreement where the 401k is the seller, and they sell the property for $100,000, retaining the other 2 warehouse units. And it gave the 401k enough capital to pay off the note with the widow. So what did that leave in the Roth 401k? 2 warehouses, which are appraised at about $100,000 a piece, that are still currently cash flowing to his Roth IRA month after month and growing every single month because, thank you, renters, they're increasing the value of his Roth 401k. Now, that is not contributions. That's profit. And that's a creative strategy of buying on terms. Okay. He could have created some sort of other agreement, but this is how you could do it. You could have done a joint venture. You could have wholesaled this property, but understanding different exit strategies and different ways to leverage your experience can basically enable you to grow massive amounts of tax-free debt in a Roth IRA. And I'll just say this, he's 32. He's starting off pretty well, I think, with his first investment in a 401k. So when you're thinking about these types of strategies, you want to match the plan with your need for money. Understand the different types of plans. And we go over this in other presentations, but match your strategy with your need for money and match that with the right type of account. All right, take this down. I want to bring Ron back up here. Ron, where are most of your Roth IRA investments and ESA investments today? What types of deals?
Well, all of mine are in real estate.
Well, I know that. What types are they long-term? Are they, talk a little bit about, what you're looking for today when you're looking for deals for your Roth and and what other accounts are you using? We kind of talked about the ESA, but from your standpoint, what's the value in the education savings account?
Well, I don't have any children under 18 anymore, so that's long gone. My children have children who have children, so it's valuable to them. But in fact, all of my children already have children. Some of them are adults. So, anyway, I have a couple of long-term deals, and I do several short-term deals in there as well. In fact, I got one just this morning that I told my secretary to use the IRA.
That's awesome. Yeah, I think every time I talk to you, you're just getting done closing a deal.
I got it. I got one under contract to sell, a little 2-bedroom townhouse that I probably had for 10 years. And it's in my IRA as well. Paid 25 for it, selling it for 200. I guess that ain't bad. Tax free.
Not bad at all. Now, when it comes to terms, are you a fan of selling on terms, or are you more of a fan of buying on terms?
Both.
Both.
I buy on terms as much as I can. And if I buy on terms, I sell on terms. If I buy for cash, I sell for cash.
And let's revisit, because you kind of touched on it, the difference in the tax liability on the different types of strategy you use. Can you touch on that again?
Well, if I use my IRA, there are no taxes.
Right.
I do it outside of my IRA. It's short-term capital gains, which would be, depending on what tax bracket you're in. Mine's 37%. So if I do it, hold it for more than a year, and then I'm down to 15 to 20%. I'm down to half the taxes any way you look at it if I just don't sell it immediately. But most of the people watching this, they're going to need those big chunks of money from the wholesaling and the rehab, so they don't have to do everything. Do some in your IRA and do some outside of your IRA, and then when you don't need cash flow anymore, do everything in your IRA. Is what I tell them to do, because they're going to wake up very rich one day if they do.
Yeah. Well, and one thing I always tell people too is, once you understand how the Roth IRA works, Roth IRAs, you have qualified distributions out of a Roth once you've had a Roth for 5 years and you're above the age of 59 and a half. If you could start acquiring and establishing some ownership of some real estate in that Roth IRA, by the time you're 59 and a half, if you've got enough money in your Roth IRA, say you've got a couple million in a Roth IRA, why would you ever buy real estate outside of your Roth IRA at that point? You could just reinvest the money in your Roth IRA and live tax-free for the rest of your life. You're basically off the grid.
That's right.
Yeah. The IRS can't touch you. The IRS hates that, by the way. That's why they say Roth IRAs can be audit triggers, because the IRS just does not like us to make massive amounts of money that they can't touch. But hey,
right.
The way that we teach it, the way that Ron teaches it is, hey, these are the rules. We're just sticking it to the man with their own rules. You can either live by them or you can ignore them, but they're out here for everybody. I want to take some questions now. Tristan, you want to hop in? Do we have some questions we can relay to Ron? Okay, well, let's take Roth IRA question. We're getting to you guys. Hold on one sec.
What's the difference between Solo K and Roth IRA? They have an account with Directed and they assume that it was a Roth IRA, but they were informed that it is a Roth 401k.
Okay. So the difference between an IRA and a 401k, there's a lot of differences, but there's a lot of similarities. First of all, they're both retirement accounts. With a Roth IRA, you can only put so much in as a contribution, right? Money out of your pocket can only total $6,500 a year if you're under 50, $7,500 a year if you're over 50. Now they are increasing that in 2024. It's going up $500. Thank you very much. But that's $7,000 if you're under 50 for 2024, $8,000 if you're above 50. That's just on contributions. Now the big difference with the 401k is you can make much larger contributions to a 401k. You can go up to $66,000 and well over $70,000 if you're over the age of 50. So there's an opportunity for a larger money dump in a 401k than an IRA. We kind of touched on the big difference between buying debt leveraged investments, buying property on terms, specifically seller financing or subject to. Those will probably be better suited in a Roth 401k where you don't have to pay taxes on the debt piece. Doesn't mean it doesn't make sense in a Roth IRA. I've seen clients take, for instance, buying property subject to in a Roth where they just hold the property until the note's paid off. That's actually a good strategy if you cannot establish a 401k because you're not self-employed. So you're forced to use an IRA. That doesn't mean you shouldn't look at investments that have terms. I have a client that's bought 5 properties, all subject to, all in a Roth IRA. Okay. He's basically just buying the property with taking over the debt, putting a renter in that property that pays off the debt. And he's going to pay a little bit of unrelated UBIT tax on the net rents, which is very small, because once your Roth IRA becomes a taxpayer and it has to pay taxes on the debt, well, now you can use depreciation and expenses to offset it. But the thing with capital gains now, when it comes to capital gains on an IRA investment where you're debt leveraged, is when you sell the property, they're only going to look at your past 12 months of indebtedness to calculate the debt piece for capital gains purposes. If you hold the property until the note's paid off and you don't sell the property for 12 months after that, your debt piece is zero, which means your capital gains liability is zero. So there are some creative strategies on how you can still use an IRA to escape capital gains tax. You just got to do a little bit extra work and make sure you have a strategy that keeps the property long term. Whereas the 401k, you can sell it and still retain all the profit completely tax free. So that's one of the, but the biggest thing is that you have to be self-employed to have a 401k, no common law employees. It's great for real estate investors. It's great for CPAs, great for people that just work for themselves that have no W-2 employees. I think you should have a Roth 401k and a Roth IRA, because even though you max out a 401k, you can still max out a Roth IRA at the same time, which gives you more tax-free dollars that you can grow and compound on itself.
All right, but there's one problem with that Roth 401k.
Shoot. Go ahead, Ron.
It's husband and wife only, and I can't have any other employees in any other business that I have that I control.
Correct. So that's why Ron can't have a 401k, unfortunately, but that's why he has a Roth IRA. So there are some qualifying criteria to have a 401k. Ron nailed it. You have to have a business that, and no other businesses where you have what's called common law employees, specifically W-2 employees. You can have your spouse, but you can't have anybody else. Tristan?
Awesome. All right. We're just going to finish up with John and Jasmina's question. We'll hit John's first. Can he use his SDIRA to help his fix and flip projects?
That would be prohibited. So unfortunately, what you cannot do is self-deal your IRAs or 401ks into deals you personally own or personally benefit from. So if you own a house today, you can't sell it to your IRA. If you bought a house in your personal name or through your LLC, you can't use your IRA to do the rehab. Now you can partner with your IRA. That is something a lot of our clients do. It could get tricky partnering with your IRA. You want to be very careful. But let's say, for example, I'll just make an easy example. I've got a $100,000 house and I want to use $50,000 from my IRA, $50,000 personally. Okay, maybe the rehab's $40,000. I can put $50,000 up for my LLC and $50,000 up for my IRA, and I own that property 50-50. Okay. When it comes to the rehab, I have to pay for the rehab or any expenses at those exact percentages, 50-50, or whatever the percentages I started with. And when I sell the property or I rent that property, any income is split exactly 50-50. That's what we call a parallel transaction. I started with the same percentages that I ended with, and I split all expenses and profit according to those percentages. Now, can it be 70-30 or 80-20? Sure, it can. But you have to make sure that you abide by those percentages and you don't leverage your IRA to either shovel more money back to yourself or shovel more money back into your IRA that are unequal to those percentages. But if you've already bought it, there's just no way to get your IRA involved in that case. You want to look into the next deal to get your IRA involved. Ron?
You can't put your house in the IRA. You cannot contribute anything but cash. And to make it real short, you cannot get compensated in any way directly from your IRA, because if you do, you're guilty of self-dealing, and you don't even, I'll let you tell them what the penalty is for that. And I'll tell you, they got people out there looking at IRAs, and the IRS knows they're just a feeding grounds for fines and penalties because people abuse them all the time and take time to learn the rules.
Yeah, well, and people got to realize the IRS is in the business to make money. Let's shoot it straight. The IRS is in the business to make money. They make money by getting taxes. So if you want to play with fire, right? And have the IRS agent knocking at your door. That the one quick way to do it is start commingling you and your IRA funds, or start self-dealing your IRA assets to your IRA, or vice versa. Now,
Tell
one
them
way you
penalty.
can go ahead, Ron. Sorry.
Tell them the penalty if they get caught.
Well, the penalty is you lose your IRA. So they don't mess around with this. The IRA has very, very good tax benefits. If they find that you've created a prohibited transaction, it could very well mean that you lose your entire IRA, full distribution, taxes and penalties, bye-bye IRA. So you don't want to mess with them on this one. But I would say if you're looking to get some IRA funds to help pay for a rehab on a property that you bought personally, look to other people's IRAs. Other people's IRAs, not yours, not your spouse's, not your kids or parents, but look to other people, brother. It could be brother, sister, aunt, uncle. It could be anybody else outside of you, spouse, kids, and parents, or their entities. There's $35 trillion in other people's retirement accounts. That's the best way to utilize IRA funds today, to put money in your back pocket, not using your own IRA. Okay. Your IRAs are for the future. Other people's IRAs can be used to help you fund, acquire, or rehab current properties that you've got now. Great question.
Nate, you should follow that up with the minute you take that money and sell that house, you're now triggering UBIT. It's just another loan. No matter who the loan's coming from, you got debt. And your IRA cannot guarantee debt either.
No.
So all of it has to be non-recourse.
Right. So that's if your IRA, if your IRA is taking on debt, it has to be non-recourse. We talk a little bit about that. I think most people understand that. But yeah, good point. But like I was saying, if you're buying property personally, here's where I see it. And Ron's students do this all the time. Ron's students are one of the best to do this. Is that with their IRA investments, those IRA investments are separate than them personally. They just keep that completely separate. They keep those deals completely separate. And maybe the strategies are completely different too, versus the investments they do personally, because they are doing some investments outside of the IRA. We talk so much about inside of the IRA. There's benefits to buying property outside of an IRA too. But if you're looking for private capital, that's where you want to start looking to raise private capital from other people's IRAs. Because we've got, for instance, 15,000 clients at Directed IRA. I would probably say 80% of all those 15,000 people are not real estate investors. They invest in other people's deals through syndications, through private equity funds, or just through private loans to real estate investors. So that's, as a real estate investor, that's where you want to tap into that private capital source of other people's retirement accounts to fund your personal deals and keep your IRA investments separate. Where do you see a lot of your clients having success with that on the private capital side, Ron? Do you guys talk a lot about that?
You mean borrowing money from other people that are lenders?
Yes.
Well, I don't know, because I don't go home with them, but they're perfectly aware that if they borrow that money, they're going to have to pay UBIT. And in fact, I think when do they charge UBIT? Do they charge it the year after you borrow it? Do they charge it when the thing is paid off, or what?
Well, what I'm talking about is more the individual borrowing money. So I lend out of my IRA because I don't really have time to find property. So if I'm going to lend to Ron LeGrand, right, my IRA doesn't incur UBIT, and I'm running to Ron LeGrand, not Ron LeGrand's IRA. I'm loaning to Ron LeGrand.
Well,
loans don't incur UBIT for me, but that's a great private capital source.
Yep. But it creates UBIT for the owner of the property that's in their IRA. I tell you what, I've done 5 different funds using private investors' money, and well over half of all of that money came from some of their IRAs. So it's a great use of your IRA if in fact you're not going to do anything with it, but sit there in the account. Because to be truthful, if you're a sharp real estate investor and you know the business, you can make a lot more money using it to buy properties, sell them for a lot more. And I mean, that's what most of the people do with their IRAs, is wholesale and rehab deals. Right. Because look, I just wholesaled 2 houses month before last, didn't touch them, and made $82,000 on those 2 junkers without touching them. Can't ask for a better deal for your IRA than that. I mean, it's incredible. And that's why people have such a hard time relating to it. And
the Roth IRA is one of the most powerful wealth building tools out there. Tristan, we got another question?
This is the last question. I'm not sure if you guys can speak to this or not. It's more of a CPA question, but Jasmina had said that she heard you guys talking about putting your child into payroll. And she wants to know if that's something that she can pay them every month towards, and if they would still be dependents.
Talk to your CPA on that one. We're not going to give you tax advice on that, but there's definitely a lot of ways that you can put your kids on payroll. We even talk a little about this on some of, Mark Kohler and Matt Sorensen's podcasts and the Main Street Business podcast. Watch some of that when it's not for this program, but there are definitely ways, as long as your kids are doing, real work, you can put them on payroll. I've seen a lot of investors do that. But talk to your CPA. There's a certain amount you can pay them without having them, pay income tax. But as long as the person has earned income, they can make contributions to a Roth. I have a client that I kind of mentioned, had 4-year-old that's got a Roth IRA. Grandmother was a real estate investor. Grandmother put 4-year-old on, well, not payroll, but paid her a modeling fee. Now, the grandmother had a legit real estate investor book. A real estate investor book that she sold online. The model on the cover of that book, was her 4-year-old granddaughter. Gave that granddaughter earned income. So grandmother put $5,000 in the Roth IRA. That was the max contribution that year. Grandmother then took granddaughter's Roth IRA and partnered with her own Roth IRA, and they bought some land outside of Houston. This is back about almost 10 years ago. Bought some land outside of Houston, subdivided the land, sold off the partials, and 5 years later, that $5,000 Roth IRA for the granddaughters were $75,000. Talk about a head start in life. Thank you, Grandma. But again, most of the people that are putting their kids on payroll are a little bit older. They legit do work. They send faxes. They do a little office work. Talk to your CPA on how you can manage that if you're self-employed and own a business. Ron, anything you want to add to that?
Yeah. We keep talking about contributions. Honestly, once you get it open, I don't care if you ever make another contribution to it, because that's not where your wealth is coming from.
Right.
Your wealth is coming from the ability to leverage your IRA into real estate, little small money like earnest money deposit, and create these big profits. Next thing, you got a boatload of money in your IRA. Now you're looking for what to do with it. I use my IRA mostly to pay cash for junkers. I just closed on one. Paid $121,000 for it. And that one I am going to rehab, but I could easily sell the house for 180 without fixing it. And it all goes in the IRA. You can't live long enough to get rich just contributing $6,000 to your IRA. I
think you nailed that right. Yeah. And this is just my opinion. I don't think in schools they teach you, really how to retire the correct way. I mean, we're always taught, work for a company, put 10% away in your 401k and save your way to retirement. I think that works for a small subset of people, a small group of people. But I find that most people don't have enough money in their retirement account to comfortably retire by the time it comes to retire. You got to be able to find a way to invest to retire. That's just my opinion. Ron?
There ain't nothing better than real estate.
Yep.
It's been around a lot longer than we have. It'll be around long after we're gone, and just so easy to make money on. There's so many different ways, but you got to get it in your head. Look, what if you contribute $6,000 a year to your Roth IRA for 30 years? What do you got? $180,000. Okay. I hope that's not what you want to retire on, because you're going to need a lot more than that. So you got to leverage your brain. And of course, there's other things. A lot of people make money in the stock markets, but more of them don't make money than do make money. Not something that I'd do if I had no knowledge of it. It's scary even if you do it. Real estate ain't like that. It don't have the risk factor. It's something sitting on a piece of ground. It's not going anywhere. And somebody wants to live in it. And there's always sellers and there are always buyers. And it goes up in value. I mean, that's a free gift. Yeah. And then there's the debt pay down, all of those things. So my IRA is almost 100% in real estate, because the returns are so big, I don't even know how to measure them.
Yeah. So I don't want to keep you wrong, because I know you got a busy schedule. Give us some final thoughts, final words. Where can people look for more education from Ron? How do they sign up? How do they get access to more of the things that you're doing?
All right. Well, ronlegrand.com/ mentor will get you onto that webinar all about terms. But honestly, you go to my YouTube channel, you could be watching lessons for the rest of your life when you're too old to spend any money out of your IRA. There's so many of them on there. And then ronlegrand.com. Been around for a long, long time. So we got anything you need in your real estate education and beyond. Just go there and play around, watch videos. I'm even on TikTok. You know that? Huh?
I haven't
TikTok.
even got
I'm
to
on TikTok.
TikTok. You beat me to TikTok, Ron.
You need to get on TikTok.
I know. I keep hearing that.
Yeah. And I'm on Instagram. It's not hard to find me.
Yep. Tristan's putting in some important links for you guys in there. Tristan, can you also put my email address in there? Nate.hair@directedira.com. If you've guys got questions on any of this, you can reach out to me. I highly urge you to go watch the Mentor podcast. Go follow Ron on YouTube. Go follow him on TikTok. I need to get a TikTok account as soon as I get off this. But Ron, I really want to appreciate you being here. I know you got a busy schedule, but you are the man. I've learned a lot from you personally, and I can't wait to do some more stuff with you guys and see you guys again at your next event.
Thank you, Nate, and thank you for what you do. You're very good at it.
Appreciate it.
You're going to save a lot of people from not having enough money to retire on. I can tell you that. And I always tell people when I check into the nursing home, I want to own it free and clear.
That's great. That's some great advice. I appreciate the kind words,
right.
Ron. Thank you again. Yep. Thank you.
pleasure.
Have a good one, and have a good one. Thanks for joining, everybody. This has been Nate Hare with the workshop for today. See you guys on the next one. We'll do one on October 24th. Go register for that on our website. So thanks, guys. Have a good rest of your Tuesday.